We are half an hour away from the opening bell in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: Asian stocks edging higher despite worries on Wall Street that the tech rally may be running out of steam after Nvidia's plunge. The yuan in focus as trading disruptions appear again.
Also ahead, Beijing set to offer tariff relief for luxury German car makers if Berlin convinces the EU to drop its own levies on Chinese-made EVs.
And I'm Stephen Engel in Dalian, where the World Economic Forum's annual meeting of new champions is getting underway here. Chinese Premier Qiang will be addressing the congregation later this morning.
All right, good Tuesday morning to you. We thought we were going to see some sort of Nvidia effect here today after that 13% plunge that we've seen in the stock in the past 3 days. Not quite, as you're seeing what in the Asia Pacific here today. In fact, we're actually seeing stocks here in the region that are really shrugging off those U.S. tech worries as well. We're slightly up when it comes to the APAC gauge here with a slight, we're pretty much flat in Japan, but really Kospi, Australia, is doing okay. Taipei, though, of course, we're still watching those key chip stocks given just the Nvidia story. But certainly the fact that we saw yields pull back, we saw the dollar pull back on Monday, that certainly is adding some support to these markets here today. Perhaps because of this Nvidia story, there is a lot of questions about, we're getting to month end, we're getting to quarter end, this whole rebalancing of flows may be what's adding to the case for many markets here in Asia, in particular when it comes to Japan. China could be one as well. We'll talk a little bit more about what we saw in that China session yesterday. But here are some of the chip stocks, of course, here in Asia are still kind of feeling those effects from Nvidia after we basically wiped out $400 million or so after being the world's most valuable company. It just goes to show that this rotation out of tech, is it just the beginning of it? Is it just something that we're talking about month-end rebalancing or something more? But you're seeing that most of these chip stocks are falling, and suppliers of Nvidia, Taiwan Semi, as well as MediaTek just coming online in Taipei, both falling as well. Hanmi Semi in Seoul also falling some 3%, but has pared back in the last few minutes or so. In terms of the setup, of course, we're watching very closely in China. So futures are still pointing positive here this morning, but as the Shanghai Composite, keep in mind, we still saw quite a bit of a sell-off yesterday. In fact, we're back to 4-month lows for that gauge as well. The renminbi is very much in focus. So it looks like we're seeing some stability at 728. But then again, we are still trading near the weak end of that trading band here right now. You take a look at what overnight swaps, they haven't traded basically since Tuesday. It's a sign that maybe if you take a look at what the implied yuan price would be if they did settle, would actually be exceeding or above that trading band. So that's what traders are at least telling us at the moment. They've actually seen state banks also step in to support the currency, according to some traders as well. So we're watching that PBOC fix very closely today.
Absolutely. In fact, from that midpoint yesterday, Yvonne, to your point, I think Bloomberg calculations have it at 1.9999%. From the trading band, of course, which effectively takes you there. Now, speaking of stepping in, right, so you mentioned some of the state banks and the currency. The question we have right now, given the spike that we had in inflows into these large cap ETFs that track some of the major Chinese benchmarks, surged on Monday, right? So the question is, did the national team show up when markets were on a downturn yesterday? We did manage to close higher for the day, off lows of the session, still lower for the day, just to clarify that as well. Now, if they did not show up, what then caused this inflow? Is it a month-end phenomenon we're looking at here? So we're looking at this very specifically going into the session today. And among that, of course, Yvonne is pointing out 4-month lows on the Shanghai Composite. 2941 is the level you're tracking there as we go into the session today, 25 minutes away. Steve, of course, is our man on the ground at Dalian, and of course the Premier Qiang is set to speak in about 90 minutes or so, give or take, of course, when that begins. We have an NPC Standing Committee meeting with trade numbers coming out of Hong Kong. That's towards the latter part of the session. Of course, things like auto stocks, crypto stocks, and also the telcos in focus following that Reuters report. And suffice to say, it's busy. We'll see whether or not these gains hold in the early goings going into the opening about 25 minutes away.
Well, let's get to our top story now. The World Economic Forum's second biggest meeting of the year is getting underway in the Chinese city of Dalian. It's the 15th time leaders have convened in China for what's dubbed the Summer Davos, and the global economy and the potential of technology will be in sharp focus. Let's get to our chief Northeast correspondent, Stephen Ingles, joining us now live from Dalian. Steve, how's it going? What's on the agenda today?
Yeah, I mean, so much is going to be on the agenda. We're going to be hearing from the Premier Qiang, who will give his traditional address here. But again, you know, we took a break for about 3 years, and we haven't been back since 2019 to Dalian for the annual meeting of new champions because of the pandemic. Last year it was in Tianjin. We were there, and I've been to all 15 of these World Economic Forum summer Davoses. But things have changed since 2019, obviously. We had the pandemic, but we've had a rise of protectionism and a rise, of course, of trade action against China and by China. And, of course, there are a couple of wars being fought. There is lots to talk about with Sir Robin Niblett, excuse me. You said Nisbet earlier, and I knew I was going to trip up. No, excuse me there. But, again, thank you for joining us. You are the Distinguished Fellow at the Chatham House. Can there be managed competition between East and West, given the geopolitics right now?
Well, Stephen, thanks for the opportunity. And if you talk about managed competition between East and West, I think you mean managed competition between the U.S. and China, or maybe the U.S. and Europe and China. Yes, I think it is possible. Yeah. But we are in a very bumpy period where the total scale and direction of this relationship has not yet been designed and known. I think when Jake Sullivan, the U.S. National Security Advisor, famously described wanting to create a small yard with a high fence, nearly 2 years ago now, the idea then was to try to have a relatively limited form of competition, or limited form of protection, and therefore managed competition. But since then, we've seen almost an accidental expansion into areas of biotechnology. It was meant to be just quantum, AI, semiconductors. Now it's biotech, it's aspect of electric vehicles. People are not quite sure, would it be cloud computing? Where do you draw the line between technologies that are really dramatically impactful on security and on the capacity for China to build up its military capability, and where do you not have to worry about it, do general trade?
Right, and on climate change as well. Obviously, a lot has been talked about the overcapacity in new energy vehicles and also batteries, solar, and the like. And trade action has been taking place. The Vice Chancellor of Germany is here trying to find some negotiations, obviously, because there could be retaliatory tariffs if the EC goes ahead with its 48% tariffs. So I also talked a couple of weeks ago with the Chinese new envoy for climate, and he says the world needs cheaper new energy vehicles. They need these kind of technologies. Where do you weigh in on the world's need, given the climate crisis, for these cheaper technologies versus protecting one's domestic economies, like in Germany and the United States?
Well, in a democracy, you know, Germany is a democracy, obviously, and it's a democracy that's done very well out of a very successful car industry. And they saw what happened to the German solar panel industry about 20 years. Wiped out by a very laissez-faire approach. It would be good in general for the economy. Angela Merkel, in fact, overrode the European Commission at that point to try to keep that trade open, and look at the impact it had. You've also got this connection where it's so different right now. Europeans look at their experience of depending on Russia for fossil fuels and getting it cheap and doing well. They don't want to repeat that mistake and then depend on China, let's say, for batteries, imported batteries at least, and then find that their new energy transition is reliant on a different country. They can squeeze prices, so there's a geopolitical dimension or a geoeconomic dimension on top of simple things of not wanting to see their position at the top of the car industry knocked out.
Now, the book that you just published in March is called The New Cold War, How the Contest Between the U.S. and China Will Shape Our Century. It's a different Cold War, you argue, than the Soviet versus U.S., the two blocs. There are other nations, non-aligned nations perhaps, with healthy GDPs that also want to come to the table with a voice. Yeah. The Global South, for example. Yeah. They're represented here. How does that change the dynamic?
Look, I think the two biggest changes from the last Cold War with this Cold War, and I think we are in one, and we're certainly heading in that direction of getting tighter, is that China relies on a stable world and it relies on engagement in the global economy. So that's one positive. That also gives more power to the global south. The countries in the global south are now not just about 65% of world population, they're close to 30% of world GDP. They've got demographic weight and growth still behind them. They've got new technologies coming in, but they're able to triangulate and play one side off the other in this new Cold War. So a country like Indonesia doesn't just say, we'll sell our lithium or our cobalt or our nickel to you, other countries. We want you to get involved in the global supply chain, come over here and help us process, in fact, help us build our own cars. So, and each side, if they want to play in Indonesia, need to come in and help them. So you've got in Africa, countries able to play now what was just China's Belt and Road Initiative is now being played off against the G7's global partnership on investment and infrastructure. So they've got a sort of a clout that they didn't have before. They're not going to be proxies, they're not going to be passengers. And India, I think, is playing this the best.
Does the return of Donald Trump in the White House escalate the presumed, escalation into Cold War version 2?
The people who believe they have a shot at having a seat in his administration, the bulk of them will heat up this Cold War. He himself, I believe, is somebody who's more risk-averse. At least, I mean, who knows? But if I just read how he handled his last term, and you read what his interests are, and his kind of deal-making instincts are not to get trapped in conflict. Certainly, if you're trapped in a war, you lose control as a president. You have to hand it over to your security establishment. So I think while he's going to have advisors who might heat it up, he himself, his instincts will be transactional. What's best for Donald Trump and his power base inside the United States?
Well, the Biden administration likes to say that they're targeting in their export controls and some of these other trade actions only about 4% of overall trade between China and the United States. I mean, it's debatable the level of impact, right? Yeah. But Donald Trump is talking about across the board 60% tariffs on all Chinese products, not just the new 3 that Xi Jinping is touting. I mean, that is a significant ramp up of protectionism and a trade war.
Absolutely. Look, the EU is negotiating the tariffs that they've announced, right, whereas Donald Trump is saying that he's just going to impose them. Now, some of this is posturing ahead of the election, and in the end, if that starts to affect inflation, if that starts to affect the cost of living for his voters, you know, he will use that, as he did last time, as a negotiating position. I'm imposing these 60% tariffs, but he'll slap them on to start with, and then try to find some scope to be able to pull back.
How does China's sluggish growth, if you will, play into this discussion? There's been a lot of discussion here in China about the de-dollarization. It hasn't happened. Yeah. We're in the king dollar right now. And through the pandemic, investment flows, about a third of global investment flows have been with U.S. dollar. No matter how much Vladimir Putin and Xi Jinping talk about de-dollarization and changing the landscape, the first big change in 100 years. How do you see it?
De-dollarization of global reserves, practically impossible in the near term, certainly so long as the Communist Party of China wants to hold on to control of the currency and be able to determine where it goes. So if it's not a freely tradable and transferable currency, it's not going to become a global reserve currency of any meaningful level. I think we're at 2.5–3% or something like that of total today. But in trade, we're definitely seeing a lot more use of the RMB in its trade, especially with Russia, where the bulk of its trade is now done in RMB. I think half, roughly now, of all of China's trade is conducted in RMB. So it is being able to create a trading currency, and a trading capability, which then makes it less vulnerable potentially to U.S. sanctions in the future. And you've noticed between Russia and China an effort to designate certain banks that will be disconnected from the SWIFT and the transfer system. China has its own nascent payment system in place, and that gives it room to be able to at least trade with the countries it wants to trade with without them having that fear that they'll get cut out of the global financial system.
Absolutely, and exacerbated by the ongoing war in Ukraine.
Exactly.
All right, Sir Robin Niblett, thank you so much for your time. Apologies for getting your name wrong. I will never happen again. I swear. Thanks so much. Then. Okay, come on back. All right, guys, so send back to you the China Show from Dalian.
Yep, our coverage continues, of course, and we'll see, of course, if Steve holds his promise there, never again. Continues later on the show out of Dalian, where Steve is, of course, and coming up on shows from there, of course, we'll be hearing from the Chinese Premier, Qiang, who will be delivering his keynote speech in the next hour. And after that, we'll be speaking exclusively with the Malaysian Minister of Natural Resources and Environment, Sustainability, and also Primavera Capital CEO, Fred Hu, there on your screens for you.
But before that, let's take a look when it comes to some of these semiconductor stock. TSMC is certainly feeling it here. This is just a two-day chart, but basically really mirroring some of the moves that we saw from Nvidia in the last 2 or 3 days or so. So extending those losses here, we're now back to about 927 Taiwan dollars for that stock here as well. So still seeing a bit of that tech unwound here this morning. We're also coming down the open of trade in Shanghai, Shenzhen, and Hong Kong. Futures were pointing positive here today. We'll see sunny skies and a very humid Hong Kong. This is China, the China Show.
All right, your midpoint for the day is 712.25 against the U.S. dollar. Reason that it holds slightly more significance today is we pushed almost to the extreme level on the trading band yesterday, 1.999999% from yesterday's fix. And given this, we'll see, of course, where the playground lies in a couple of minutes. Let's get instant reaction right now from Stephen Chu, our Chief Asia FX and Rate Strategist, to talk us through what do you think of today's midpoint?
So the market was expecting some support from the previous week, given the weakness, renewed weakness in the yuan again. But it's interesting that they still persist to have the fixing above 712, which, to our point before, over and over again, that if the dollar stays strong, even though if they're trying to hold the fix, eventually they will have to let the fix to drift higher, however slow it is, just because the basket will be too strong. Now, right now the basket is near 98 using CNH, which is about fair value. So we think that's okay, so they can sort of have some room to let the fixing to keep at current level. But if the dollar stays strong, the rest of the currencies, especially the yen, if the yen breaks through 160 again, which is very likely given what market has expected, then the yuan will have to start to drop a little bit more against the dollar. So the fix inevitably have to shift higher.
We were hearing from overnight swap, or traders saying overnight swaps basically haven't been traded. I mean, what do you make of these sort of disruptions?
I mean, it's clear that the PBOC want to give a gesture that they don't want you to speculate about further upside. So even though it's really nothing, because like for overnight, for Tronics, it's always about the bend if you're looking at the discount, the 4 points. So that's why even if they curb that, that means that do not speculate in the spot space even though we are drifting the fixing higher.
Okay, yeah. Stephen, fantastic stuff. Okay, we'll watch it certainly closely. And of course, dollar yen, to Stephen's point there. Stephen Chu, our Chief Asia FX and Rate Strategist at Bloomberg Intelligence.
Yep, and shifting to broader markets now, of course, and Asian chip stocks are weaker following the slide in Nvidia. And our data really shows that when it comes to that move that we saw the past 3 days, biggest three-day value loss for any company in history. Let's get to our tech reporter, Annabelle Drewler, is joining us now. So, yeah, we made it to the $3 trillion club for Nvidia. It didn't last too long for the company.
No, it was entry and then exit pretty much. But, yeah, so Microsoft, Apple now, of course, going past Nvidia once again. But the theories as to why this is happening now, that's certainly sparking a lot of debate amongst different analysts and investors. So there's a few different ones that are being posited. There's the chance, of course, that there's just simple profit taking that's taking place, and we've seen a number of even Nvidia directors and executives selling their shares over the course of this year. There's profit realignment as well, because we're June 25 now, so you're approaching that end of the second quarter. So investors, again, just looking to rebalance their portfolios. There's also the possibility, of course, that there's just concerns or question marks over the health of this rally. AI fatigue could be setting in, concerns about index concentration. There's been a lot of concerns around the lack of breadth in the market. But, of course, the question next is, where do you go from here, and where is the Nvidia stock heading? And there's, of course, a lot of different technical analysis looking at this, but one of those is just applying Fibonacci retracement levels. And right now the stock is around 118. The next support level, you're sitting at 115, so you're just a few dollars off that. If you do reach that point, then some are flagging, well, you know, $100 a share could be the next sort of line in the sand, and a good and perhaps possibly attractive entry point for some people as well, Dave.
Yeah, well, for some. Let's see. Our folks at Bloomberg Intelligence have also done some work here on the sway that AI stocks have. What do we know about that?
So this is more looking at the comparison of the influence of AI now on the broader markets versus what tech had back in the dot-com era. And actually what they're finding is that AI now is a lot more pronounced than tech ever was during that period at the late 90s. Again, a few different factors, but some of the ones that they're highlighting in particular is the role of AI and earnings growth for the broader S&P 500 index. So it's actually a huge driver of that. We did not see that so much, again, during the dot-com era. The other impact as well is just the size of AI firms leading into the AI boom. So just even ahead of that rush, AI companies were still making up roughly a third of the S&P 500. Now it's around 40%, but again, you didn't see such a level of concentration during the dot-com era. Also worth noting the extreme market distortions that you're seeing from this, and they really highlight in Asia, Taiwan and Korea in particular. If you were to strip out the influence of AI, and that of course relates to a lot of the chip names, but the Kospi would have had negative returns so far this year, and Taiwan's growth would have only been around 7% as well. So it's really just that outsized influence it's having in a lot of different factors.
Yeah, and it's a problem for fund managers too, right? Because how do you replicate the index or outperform the index if you don't have the stock? Belle, thank you so much. Annabelle Jewelers there on the latest on Nvidia, and of course the pressure we're seeing across a lot of these semiconductor stocks here in the region going into the Tuesday session. Hang Seng Index, your pre-market looking like this. Dollar China, 712.25 is your midpoint for the day. The Tuesday session, 7 minutes away. You're watching The China Show. Okay, we're going into the session today with some modest gains, looking at, well, ahead of the open, and just keep in mind we're coming off a very, well, the session yesterday was almost as flat as the Earth, if you believe a minority camp, of course, out there that look at the sphere and say things you can see all the way out through. Anyway, extremely flat session yesterday, 31% to the upside today. A couple of stuff we're tracking here, too.
Yeah, cosmetic stocks are something that we're watching out for. Loss of 10, that's one that we're watching here, getting a downgrade from Citi. So they're basically saying after their earnings, full-year net income miss estimates. That triggered that downgrade there. So that price target now at $34. Sasa International as well, cut to hold at Jefferies. And they're talking about, look, the sales and margin trend not looking good. Slower is what they say. For Hong Kong beauty products retailer, and they really talk about those margins that could be under more pressure there. And Greentown China, price target cut to Morgan Stanley on slower sales growth, also weak margins, so watching the property space as well.
Yep, this Reuters report takes us into the telco story today. So China Telecom, China Mobile, and China Unicom are being investigated in the U.S. over concerns that the firms could exploit their access to American data through their cloud businesses. So we're not really seeing much reaction in the stock today. We'll keep you abreast, of course, on the story. Any market reaction here. Tencent want to watch as well. So we have a number now on Dungeon and Fighter. So we're looking at topping 270 million over 30 days. Stock is up 0.4%. This should take you back about 2 weeks as far as price goes. There we go. Futures going into the Tuesday session, we're pointing slightly higher here in Hong Kong. Flats as we look at what's happening in the mainland. The Tuesday session is just ahead. This is Bloomberg.
Welcome back. You're watching The China Show. We're kind of on the open of markets here right now. We talked about, maybe there's a bit of rotation back into this region here. Maybe that's what's keeping some of these equity markets elevated here today, despite that massive drop in Nvidia the last 3 days or so. But already yesterday, it was close to a 7% drop here. So chip stocks very much in focus. We're also kind of down to what's going on at the summer Davos or the WEF, World Economic Forum in Dalian, where Qiang is set to speak pretty soon, Dave.
Yeah, about an hour from now. Well, stay tuned for that. Lots more coming up, of course, out on our coverage on the ground in Dalian with our man on the ground, Stephen Engel. 10 seconds to the opening bell. A couple of things, right? The fact that we are not poised to open lower, actually, if you think about it, bodes ill. Simply reminds us of the fact that we haven't actually joined in on that AI rally to a large extent here. In the Greater China region as well. Okay, a couple of things. Shanghai Composite, a specific level to watch 20 points below the current levels as well. We're getting another bounce today in Guizhou Maotai. Open lower yesterday, cascaded even further, and then ended the day higher. When you look at some of the technicals, for example, the most oversold, very near that level on record. I think we're now trading at 15 on the 14-day RSI. Here in Hong Kong, let's flip the boards, please. So Tencent, we're going to be very much in focus. We have a number now, and more on that in a moment here on DNF, 270 million. So we're looking at that. We're looking at the Asia Pacific, which is now up 0.5% because of the open higher we're seeing here today. Flip the boards, please, if we can. So you have Tencent. NetEase would be, I guess, the next sort of name to watch. Some of your crypto-related stocks on the back of the drop in crypto. In Bitcoin overnight, it took out 60,000. I believe we're right above that. Thank you so much. That key level. MMG, 1% to the upside here. Goldman Sachs out, raising that stock to buy from current levels 313. What's this price target? 390. What's that? 80 cents? 25% upside? We'll see if my math is correct. We'll see. Telcos, Telecom, Mobile, and Unicom on the back of this Reuters report that they're being investigated in the U.S. here. On the back of their cloud business and the exposure there. Want to watch? We're not seeing any reaction. In fact, the opposite here. And as promised, I'll end on this. Shanghai Composite, 2962, 2942 is the session low we hit back on Feb 29, which might be your next level to watch. Below that, we're back to about levels of mid-February. So, yeah, We'll see whether we take it out. At the moment, we're up 2 points, so maybe it could be one for another day. Yvonne.
Yeah, you mentioned about some of these geopolitics. Let's focus on what's been going on in the EV space as well, because you take a look at what's been, obviously we heard about yesterday that these talks between the EU as well as China are starting when it comes to these EV tariffs as well. And what we're hearing now from our sources that Beijing is said to be floating benefits for Germany's luxury car makers if Berlin convinces the EU to drop tariffs on Chinese EVs. Our China correspondent Min Lo joins us now with the details. So, Min, what do you think China can offer in these trade talks here to maybe avoid some sort of trade war now?
Yes, so the Chinese Commerce Minister Wang Wentao met with the German Economic Minister Robert Habeck on Saturday in Beijing, and he's said to be offering to lift the existing tariffs of 15% on vehicles with large engines from Europe. Now, this affects companies like Volkswagen, BMW, Mercedes, and this is really Beijing's way of dangling carrots and sticks in front of Germany, because previously Beijing had also hinted that they could unleash 25% tariffs on those very same vehicles. Now, we know Germany has this massive auto sector that can really pressure the government to perhaps break ranks with the European Commission and persuade other countries to do the same just by leaning on its weight as the largest EU economy here. And the German Chancellor Olaf Scholz also indicated that he preferred a negotiated solution. He said there is still time before that July 4th deadline when the provisional tariffs kick in, but we're really just less than 1.5 weeks away. But of course, there's a wild card that the clock could stop ticking, because some analysts said that the EU could postpone the imposition of those tariffs until the negotiations are concluded.
Meanwhile, across the Atlantic, the Canadians are up to something, and they're looking to sort of increase the guardrails ahead, of course, of NAFTA negotiations. What do we know there?
Yes, so Canada is now announcing that it would start a 30-day public consultation period. That's the first stage before they can impose tariffs on Chinese electric vehicles. But it's not just tariffs in focus. The finance minister announced that they would be relooking at adjusting these eligibility criteria for consumers to qualify for a federal rebate program. Currently, EVs from foreign companies qualify for that program, and they may also want to relook at increasing restrictions for investments into the EV sector in general. So pretty sweeping changes that could come for Chinese EVs. But again, we've mentioned before that Chinese EVs do not have a huge presence in Canada. But this is likely to be intended to close that side door that Canada can offer, because Canada has that free trade agreement between Mexico and the U.S. So that would prevent Chinese EV makers from circumventing those 100% tariffs that the Biden administration has imposed.
Min, fantastic. Min Lo, our China correspondent there. To just pivot to another story here, we're watching Tencent closely today. Stock should be coming up on your screen shortly. After independent research data showed that its new game, and also Yvonne's favorite, I believe, Dungeon Fighter and Mobile, topped $270 million in sales within a month of its launch in China. Let's bring in our Bloomberg Intelligence equity research analyst, Nathan Naidu, to talk us through this. Maybe Yvonne can also react. Nathan, very competitive market here in China. What are the drivers behind the success of this game?
First of all, the Dungeon and Mobile brand is not new in China. The PC version of the game was first launched in 2008 on PC and has since been popular among gamers in China since then. So it has a pre-existing history and popularity. The second, I think, more important factor is that Tencent is publishing these games. Tencent comes with a lot of expertise in making mobile games and make one that monetizes well. In fact, if we look at Q1 of this year, top 10 grossing games in China, half of those are published by Tencent.
Yeah, I'm not an expert. I had to Google what DNF stood for, okay? That's just how much I know about these sort of mobile games. But Nathan, what does it mean for Tencent? Also, what does it mean for Nexon, the Japanese game publisher?
Right. So Tencent publishes the game, and domestic gaming business for Tencent, accounts for about 20% of overall top line. And given that the game is now so successful and it has other successful titles also in the running, we are seeing that Tencent can grow 2024 gaming revenue in China slightly faster than 2023, with a lot of those growth actually might come in the second half. And for Nexon, which is the owner of the intellectual property Dungeon and Fighter, it earns about, typically Chinese publishers give about 10 to 20% of royalties payment to their overseas partner. In this case, that overseas partner is Nexon. Assuming 15% of royalty at the current going rate of revenue, that could be about 8 to 10 billion yen of bottom line, compares to about 20 billion yen of net profit estimates for Nexons in Q2. So that sets Nexons up for a good beat in consensus estimates for the bottom line.
Right. And just looking further ahead, what's the outlook for the game?
Yeah, so the game has outranked, long-time rival games like Honor of Kings, as well as Park Battlegrounds, or otherwise known as Game for Peace in China, because they like the peace tone. They don't like battle and anything violence. So those two games have been consistently in top 5 in China since 2015 and 2018 when they were first launched. And, also Dungeon and Mobile is not new in China, because it's new in China, but it wasn't new elsewhere. It was first launched in South Korea in 2022. If we look at the user retention rates there, it is showing similar levels of user stickiness to Honor of Kings and Park Battlegrounds in China, the top, one of the top games. So these two factors gives us confidence that the game will continue to do well going forward.
Are playing video games part of the whole job as being an analyst?
Yeah, in the name of market research. I have to know my products. I could even do it at my desk sometimes.
It's professional, yes.
Yeah.
Okay, doing it for research.
We will tell your boss then.
I just know so much. I love it. All right, Nathan, thank you.
Fantastic.
Nathan Naidu, Bloomberg Intelligence equity research analyst, joining us. Talking about Tencent and Dungeon and Fighters.
DNF.
He sold me. I got to check it out.
Yeah. Google it again.
Plenty more ahead. This is Bloomberg. All right, some big voices that we're hearing out of the World Economic Forum in Dalian. Ping An Insurance. So the Chinese economy is likely to pick up again. And once it does, the quality of that growth will be on a much better footing. We spoke exclusively with the group's co-CEO, Michael Guo, at the WEF in Dalian.
Our earning capabilities are actually highly linked with the Chinese economy. But when we look at the Chinese economy, we cannot just take a time cut from one here and there. We have to look at things and put things into perspectives, look at the historical growth models, and look at how it can move forward. So we do have strong belief that the economy is going to regain its growth momentum moving forward. However, the quality of the growth will be much higher than what we had experienced before. And if you look at the whole things, we do believe economies go in cycles, right? And which, with the size of this economy, we could have big and small turns. We could have, sharp turns as well. The question is, how do we navigate through the different cycles, and how do we regain from some of the downs, and when we go up, we can become healthier. And this is, I think, this is something that the government is working on, the whole business community is working on. The Ping An is certainly trying to put our efforts into helping the growth of the economy to back on track and in a much higher quality.
How about new business value? Essentially, of the profitability of new life insurance policies rose 21% in the first quarter, followed by 36% jump in 2023. Can this be sustained, I guess, is the overarching question.
Right. If you look at the life insurance industry in China, if you look at the depth and the penetration, you look whatever numbers, ratios you look at, and comparing to what's happening in the more developed markets, like US, Europe, or even Taiwan, Hong Kong, and you will see there's very strong growth potential for Chinese life insurance industry moving forward. So we do believe this is a very strong growth opportunity for us. And Ping An being one of the largest and prominent life insurers in China, and we do believe we are able to take good advantage of that growth opportunity, right? So you do see our value of new business being going up, our productivity of our life agents being going up, and also more importantly, their average income for the life agency is actually going up as well, which is very important to keep the agents at very high quality and a stable pace. So moving forward, we do have a good sense that our business is going to continue to grow strong and moving forward.
I know you say you don't want to look at necessarily one sliver of time, but the first part of this year, in particular January and into February, obviously the stock market was really sluggish, and you had those low bond yields. It really eroded your investment returns. Yeah. How are you rejigging your portfolio to make sure that you're not consistently pressured on the investment returns that investors want?
Right. It's actually it's very important, the investment returns for our life insurance business. But when we look at the investment, we take a much broader perspective, not just into stock market, right? Because we have policyholders with our policies for the 20, 30 years, and we have to make sure our investment strategy matches with the nature of our business. So in terms of duration matching, we have to weigh in the different risks versus the return kind of profile of our investment. We need to look at regulators' requirements into what can be invested, what actually we should avoid. So we got different things to look at and to actually trying to balance out return versus risk and also the duration of our return moving forward.
And that was Michael Guo, the co-CEO at Ping An Group, with, of course, our Stephen Engel on the ground there in Dalian. Just some big corporate stories we're also tracking at this point. So UBS has agreed to sell the majority of its stake in Credit Suisse's China venture to a Beijing-backed fund. The sale values the brokerage at around $253 million here. Beijing State-owned assets management company takes an 85% stake, leaving UBS with the remaining 15%. Now, the deal is a blow to the ambitions of Ken Griffin's Citadel Securities to expand in the Chinese market. ByteDance is said to have discussed a potential collaboration with Broadcom on an AI processor. Now, a source tells us that the companies have talked about a 5-nanometer purpose-built chip to ensure a steady supply to the TikTok parent. Reuters earlier reported that the proposed chip would comply with U.S. trade restrictions on China. Now, the Fed is said to have shown other U.S. regulators possible changes to its bank capital overhaul that would significantly lighten the load on Wall Street lenders. Bloomberg sources say the revisions could lead to a 5% increase in the capital cushion that, well, large banks need to now maybe hold. That's down from about 16% in the original plan, which faced resistance from lenders and also some Fed officials. Markets are mixed at this point. About 50 minutes in the cash market session. Plenty more ahead here on shows. This is Bloomberg.
Welcome back. You're watching the China Show, and you're looking at live pictures out of Shanghai this morning. We're still watching that CSI 300, Shanghai Composite as well. Still seeing a bit of a downdrift here today. We're down about a fifth of 1%. 4-month lows, I believe, for the Shanghai Composite as we speak. We're also watching some of these longer-dated CGB yields also watching very closely where that goes today. Let's talk about Shanghai, though. The high-end real estate market is bucking the national property crisis, as we're starting to see that the rich spending millions on luxury residences in the mega city. Let's get to our Asia investing editor, Russell Ward, joining us for more. So it seems like Shanghai is still that bright spot in the real estate industry. But why do you think the luxury sector, in particular in the city, is booming while the rest of the market is still stuck in this deep slump?
Morning, Yvonne. Yeah, it's quite surprising. Really, this boom in Shanghai is being driven by rich Chinese people who live in the area, who live in surrounding areas of Shanghai. Remember, this is China's premier financial hub, so there's always been a scarcity of luxury housing in that area. And what we've seen recently is some of these luxury homes have come onto the market, and there's been so much pent-up demand that people have rushed in to purchase these homes. They've also got a sense that some of these homes are being put on at a relatively competitive price, so they're sort of seeing bargains out there as well. And this is all against the backdrop of property easing as well in Shanghai and other cities. So Shanghai has been lowering down payment requirements and easing other restrictions. So that's also been a bit of a tailwind for people in the luxury end of the market who want to get in. So, you know, it really is an outlier, but yeah, it's quite surprising. You know, luxury homes are in vogue in Shanghai.
Yep. So that's the Russell. That's the why. What's the what? I mean, just give us a sense of prices in this segment. How are they trending? How are they likely to trend against really the rest, to your point, the rest of the country where prices are really falling at the fastest pace in years?
That's right, David. I mean, you have to bear in mind that Shanghai, the overall price market in Shanghai is relatively solid. Prices aren't falling there. You know, prices are falling overall around the country, but Shanghai has been one of the least weak markets in general. And then you look at the luxury end of that, prices have actually been soaring. They've risen 18% in the past year. So, you know, that's partly due to authorities lifting a cap that was on prices of new homes that was put in during the bubble years. So that's gone. And there's also a sense among home buyers that prices of existing properties are even higher. So people are going in there, buying the new homes, knowing or feeling that the property they're buying is going to retain its value. Existing homes in the same neighbourhoods are worth more than that, and so they're going in and buying these properties and sort of having I guess the same sort of mentality that most Chinese home buyers had until this recent slump, which was that you can buy a home and rest assured that it's going to retain its value and it'll be a good store or investment. Unfortunately, we can't really say that for the rest of the market. Home prices have been falling rapidly, and despite the stimulus that's come in, you know, that's really put a dampener on home buyer sentiment, and people are questioning, you know, whether buying a home is a good investment. In the luxury market in Shanghai, it's a different story.
It certainly is. Sounds like Netflix needs to make a new show, Selling Shanghai or something, just to show these penthouses. Russell, you really sold me there. Russell Ward there, Asia investing editor, just to tell us what's going on in this luxury property market today. To the stories that were following around the world, WikiLeaks founder Julian Assange will be freed after 5 years in a British prison as part of a plea deal with the U.S. Sources say he will plead guilty to leaking U.S. national security secrets and be sentenced to time already served in the U.K., allowing him to return to his native Australia. And the U.S. has pursued Assange since his website published thousands of leaked military documents in 2010, including video of a deadly attack in Iraq on civilians and journalists. Israeli Prime Minister Benjamin Netanyahu says that intense fighting in Gaza will soon be paused in order to redeploy some forces to the north of the country to fend off Hezbollah. Netanyahu told Israel's Channel 14 that the military will continue its campaign to eradicate Hamas, but switch to more targeted operations. Netanyahu also signaled he would only accept a partial ceasefire deal. South Korean authorities say 18 of 22 people killed in a fire at a lithium battery plant near Seoul were Chinese migrant workers. The cause of Monday's fire is under investigation, but officials say it may have been sparked by exploding batteries at the aerosol factory in Hwaseong City. Yonhap reports the fire has been fully extinguished.
Right, so just another check of markets right now, away from equity markets, and for now at least. So we're looking at a rally that is persisting, I think is the very simple way of putting this. in the CGB space. And as you can see today, really led by the rally we're seeing on the long end of the curve here. So the 30 years down 2.3 basis points, the 10 years down about 1.4. And we're slowly approaching the trough that we hit a few weeks back, and that really in some ways precipitated the pushback coming out of authorities, talking about how if inflation comes back and you're sitting on many of these CGBs in your balance sheet, that's a problem waiting to happen. Watch what happens here, is what we're trying to say. Right, across the region, though, and we're looking at China, too. Let's start with that here. So it's a mixed picture across the equity markets with, now it's actually slightly higher on the CSI 300. The Hang Seng Index, though, is really carrying the load, if you will. HS Tech is up 0.4%. Let's call it 1% on the Hang Seng Index. We talked about some of the CGB spreads as well, and then the curve today. Dollar China, the weakest fix going back to in November of last year, or year to date effectively here. So the PBC is continuing to adjust to the strong dollar reality. North of 712 was your fixing of the day, and we're mixed across some of the current commodity markets here, with iron ore continuing to see some downside over in Shanghai.
Yeah, your Asia dashboard is looking like this here right now. So we talked about, really this region doing relatively well compared to what we saw in the U.S. So infotech is certainly the weaker side of things, and really the only sector that's in the red here. In fact, everything else is doing quite well. Look at the financials, consumer discretionary, energy stocks here as well. So certainly there is maybe that rotation out of tech that is filtering through here in the Asia session here today. U.S. futures, though, are still flat, and it's still a softer dollar story here. We'll have plenty more guests coming through from World Economic Forum in Dalian.
I think that's what everybody is hoping for. China finally bouncing back from pretty much the bottom. I think the whole world needs China in terms of economic impetus. So the whole industry is dealing with this issue of a stable source of supply for critical raw materials in the midst of huge uncertainty and complexity in raw material availability, pricing, and even geopolitics and all the regulations.
Our earning capabilities are actually highly linked with the Chinese economy. We do believe economies go in cycles, right? And with the size of this economy, we could have big and small turns. We could have, sharp turns as well. The question is, how do we navigate through the different cycles, and how do we regain from some of the downs, and when we go up, we can become healthier.
If you talk about managed competition between East and West, I think you mean managed competition between the US and China, or maybe the US and Europe and China. Yes, I think it is possible. Yeah. But we are in a very bumpy period where the total scale and direction of this relationship has not yet been designed and known.
Some of our guests speaking ahead of the World Economic Forum now getting underway in Dalian. You're watching the China Show. And of course, in just a few minutes, the Chinese Premier Qiang is set to address the gathering later on this hour. Let's get to our Chief of Asia correspondent, Stephen Ingles. He joins us on the ground there from Dalian. And Steve, you mentioned it's been 5 years since the World Economic Forum was in that very city. And certainly there's a lot that's changed in those last few years as well. And they're talking about a theme of the next frontiers for growth. What's in store?
Yeah, I think everybody's seeking alpha. They're looking for the new frontiers of growth, obviously, and they're looking for clues from the Premier Qiang, who will be speaking within the next half hour here, giving the keynote opening address here in Dalian at the annual meeting of new champions, the World Economic Forum. And what do we expect from him? Well, probably similar brushstrokes from years past, where he will likely say that China is open for business and has always been open for business. That's what these forums are usually for. But again, we'll also kind of be seeking clues as to where the policy direction will be going, because keep in mind, the Central Committee's third plenum will be held next month in Beijing. We don't have the exact dates, but the third plenum is when they basically outline the policy strategies and priorities for the longer term. And this was something that was delayed. It's usually held within the year after the Party Congress, which was held in the autumn of 2022. So within a year, it should have been last autumn. It's been delayed by about 6 months. What does that mean? And what does that mean for the policy direction going forward from the Chinese government is something that we're really going to be looking forward to. Also, any clues on any type of retaliatory action that has been bandied about in state media and by some government officials against the tariffs that the European Commission is considering right now on electric vehicles, upwards of 48%. Already we're seeing the Vice Chancellor of Germany has been here in China the last week or so and has garnered at least some progress on getting face-to-face talks to potentially mitigate the impact of any kind of trade actions from Brussels and what that retaliatory action might be from Beijing. So obviously, so much to be discussed. We're probably not going to get a lot of the answers from Qiang, but we're going to be listening.
Absolutely. But Steve, give us further context if you could. I mean, I believe this is the 15th year or the 15th edition of Summer Davos, and you've covered many of these conferences in the past. How does this one? How do things feel different this time around?
Well, things have changed, obviously. The geopolitical environment has obviously changed. And in 2007, when they held the first World Economic Forum, Summer Davos, China was on its ascendancy. There was great cooperation between East and West. The supply chains were intact. But a lot has changed, obviously. There's been a rise in protectionism. I guess you could potentially say from 2016 onwards between China and the United States with the rise of Donald Trump as president. There's that specter as well of him returning to the White House. And, of course, obviously the Biden administration has not let up on those, tariffs on Chinese products. In fact, they've added to them with export controls on high-tech products. And China, of course, too, is facing with that reality and pushing new productive forces. Some would say that has led to overcapacity in green tech products that we're seeing the reaction from the likes of the European Commission, from Washington, which increased its EV subsidies, tariffs, not subsidies, on Chinese imports to 102%. Canada also considering it. So there's just a lot of geopolitics. There's the war in Ukraine. There's the war in Gaza. There is the tech war, AI supremacy. So much has changed, Dave, obviously, as China and the United States, or you could say China and the West, are battling for supremacy in the new frontiers of growth.
Steve, fantastic context. Our Chief North Asia correspondent there, Stephen Engel, of course, will be continuing our coverage there out of Dalian in a moment. So speaking exclusively, of course, about the Malaysian Minister of Natural Resources, Environment, Sustainability, and also Primavera Capital, CEO Fred Hu. Just for context, of course, 2007, that was when the world was embracing the rise of China and how much has changed. The world is now pushing back against what China's become and wary of what it further could become, of course, as far as this economy goes. Right. Very briefly, across these markets, about 35 minutes into the cash market session, CSI 300 is now effectively flat for the day. Nothing happening there, so change the page, please, as quickly as we can. Chip stocks leading declines, particularly these names in Japan like Disco. To a lesser extent now, TSMC, which was down about 1.5% earlier on, pulling back from those lows of the day. And just very quickly, Asia ex-China, and bottom of your screen says Bitcoin back above 60,000, so we're better by about $1,000 on Bitcoin, and Asia is better by about 0.8%. Yep,
so things looking okay here in the region as we speak. We have a 107 handle for euro dollar as well. Seems to be some calm in those European markets that are coming back as well as we get closer to those election voting and the like this weekend. Dollar yen, as we talked about, 159.36, still flirting with that 160 handle, but we are still seeing some strength in the Japanese currency here today. Coming up on the China Show, we'll discuss market strategy with Oreana Financial Services. Their global CIO, Poole, joins us live next. This is Bloomberg.
Slightly stable, slightly higher. I think it depends on really where you're coming from here. It's green. That's what matters, at least. US futures following the drop overnight, led by certainly some of your big tech names like Nvidia is down. Well, it was down 6%, lost, $400 billion in value. Do you buy this dip in AI, or is this the start of a longer-term correction? What is the appropriate equity exposure at this point in time going into the second half of this year? Just some of the questions we'll be posing to our next guest, Poole, Global CIO and portfolio manager at Oreana Financial Services. Isaac, pleasure to have you on the show. Good morning, sir. Let's start with that. Do I buy this dip we're seeing in these very highly concentrated names like Nvidia, for example, and the big tech names, or do we stay away for now?
I think you proceed with caution. We've seen such a big run-up in such a short time across US equities, but particularly this concentrated leadership that we've been suggesting for a few months now not to chase the rally. And I would say here, it's probably not the time to start buying the dip either, because when you look out over the next 6 or 12 months, beyond the very idiosyncratic risks in that concentrated leadership, there's broader macroeconomic risks that are really starting to bubble to the surface.
Okay, can you tell us a bit more about those macro risks? I mean, it seems like the market still thinks this is a soft landing scenario in the U.S. What's wrong with that narrative?
I think what's really wrong with it is the soft landing has this forecast built into it that the unemployment rate, for example, will just plateau at a nice easy number of around 4% or so, even though we've seen it increase from 3.4% to 4% in a pretty short period of time. Historically, we've never seen the unemployment rate plateau when you start to get momentum behind an upward move like that. And so expecting unemployment rate just to sit at a comfortable level for the Fed is relatively heroic. And if we do see it pick up, then it could really exacerbate this doom loop that we're seeing in consumer retrenchment, the decline in consumer spending that I think really is a challenge to the soft landing narrative.
So let's then strip out, let's say, the tech names, because we could have a separate conversation on whether or not those valuations are make sense. And you look at the broader market. And when you look at the broader market, Isaac, do you think that we're priced or we're positioned for a slowdown ahead?
Not quite. And I say that because even outside of that narrow leadership, there are valuations that look stretched and there's earning expectations that look fairly unrealistic. When you look at sales growth, it has been slowing rapidly, unsurprisingly, because economic growth has been slowing. But the other part of earnings, which is margins, have started contracting. And that's really turning from what had been widening margins over the last 5 or 6 months. There's far less pricing power now. Consumers are more sensitive. The ability to rely on margin expansion to drive earnings growth is just falling out of the market. So we're pretty cautious on the outlook for earnings growth. We're cautious on the outlook for economic growth. And so even outside of that, those narrow leaders, we think that there's going to be a challenge to what's being priced in terms of a soft landing. And that does leave us looking at US equities in particular very, very cautiously from here.
And does that lead you to lean more towards the fixed income space? I mean, how much, what in terms of returns and bonds right now, is that looking more appealing to you than equities?
Well, there's fixed income and then there's fixed income. On the Treasury side, on high quality government bonds, we think this is a great place to be and perhaps even to start moving out from cash or cash-like or beyond the 2-year duration to something further and locking away what are pretty reasonable yields, but more importantly, really decent downside protection and portfolio resilience. Then there's corporate credit, where I think investors have been sucked into the absolute yield and are ignoring the fact that credit spreads are incredibly narrow and really not compensating for the risk there. And we are seeing defaults and downgrades start to pick up. So that's an area that we would look to avoid, particularly in the high yield space. And even in the investment grade, I think you've got to be careful, go for short spread duration and the highest quality that you can access.
Okay, and just to clarify too, on government bonds, what's your thesis there? Go up in duration. Just to clarify that first point you just made there, Isaac.
Yeah, I mean, we're seeing yields that were back up around 5% a couple of months ago. That was really attractive. They've come back a little bit, so we still think even at these levels that you're getting a reasonably attractive yield relative to history. But if we see the Fed cut, and I think this is important, if the Fed cuts or waits till November or December to cut, which is the consensus, I think they might have to cut 0.5%. I think they'll be going to emergency rate cuts, not surgical rate cuts, and that is really not priced into markets.
Wow. So you think that they might have to do something that's out of the ordinary then, right? That they are behind the curve in a way that they have to actually implement a series of these sort of rate cuts. Can you lay out that scenario a little bit more, Isaac?
Yeah, I mean, I think that's the risk. And it starts with the labour market, where we're seeing jobs numbers that look okay. But when you look at the household survey and the unemployment rate, it's really starting to bang up against the so-called SARM rule, that increase in unemployment rate that is consistent with recession. November's still a fair way away. If we get 4 or 5 months of even a 0.1% increase in unemployment rate, we're going to be starting to feel like a recession. The Fed is not going to be cutting 0.25%. They're going to have to go a half. And then they might have to follow that up with another couple of quarters in a very short space of time.
Okay, well, so the notion that the data deteriorates fairly quickly around the corner, how much conviction do you have around that? And simply the reason I asked that, Isaac, just to push back, is there's nothing, not exactly nothing, there's very little in the data that suggests that we're headed in that direction. And even the Fed's going to tell you so. It's very hard to make the case for even one cut this year, let alone an emergency 50.
Therein lies the challenge with, I guess, Fed forecasting and market forecasting, this premise that the unemployment rate can just plateau at 4%. It never has before. I don't expect it will again. And the reason is these deteriorations or cracks in economic data come slowly, gradually, then all of a sudden, all at once. And you get this non-linear snap where people aren't expecting it. And I think looking at the unemployment rate, looking at the initial jobless claims, looking at the consumer spending, retail spending, those fissures are starting to appear. And it can accelerate very, very rapidly and suddenly.
Yeah, you mentioned then it's time to maybe take a pause in this U.S. equity rally. Maybe this rotation out of tech has more to it. Isaac, does it mean that some of these flows? I mean, where does that mean where flows are going to go? Does that come to this part of the world? Does it come back to this Chinese stock market or even Japan in some way? How do you see it all kind of playing out?
Yeah, I mean, I think we're going to see perhaps some movements back into China, particularly if there's further policy support to try and shore that up. The hope that China can ride to the rescue, if you like, as it has in the past, and perhaps provide some uncorrelated returns. And it is, in a relative sense, got some pretty good valuation in the Chinese market specifically. I think what we're going to see is investors be very, very careful with where they allocate and really move towards a quality tilt or a quality value tilt in their equities, move more defensive. And just try and shore up against what could be a reasonable correction towards the end of this year.
You know, that's something you mentioned, uncorrelated. Something that's held up better than most years relative to itself is gold. I'm wondering, what do you think about gold, Isaac?
It's been an unusual year for gold because yields and real yields have been really resilient, and typically that is painful for gold. I think people are still looking at the risk of inflation and saying, hey, this isn't too bad of a place to be. And realistically, real yields and nominal yields could be moving lower, which could provide a little bit further support for gold. And so that is helping to support the asset class.
You mentioned in terms of risk off and maybe havens, the yen could be a part of that. I'm just wondering in what case, because right now we're seeing this yawning yield gap between the U.S. and Japan. It doesn't seem like any intervention works at this point.
Yeah, I mean, there's definitely some momentum pushing against the yen and holding it up, and we're hearing jawboning, and of course the Bank of Japan takes forever to move, but they could hike again in July. I think we'll see more intervention, but more importantly, if we see global growth slow in a material fashion, if the market starts pricing in rate cuts from the Fed and particularly the risk of an emergency cut, that's when money starts to be sucked from overseas back into Japan, and that risk-off currency comes to the fore. So we would say in that scenario, 140 would be realistic by the end of this year, maybe even stronger than that.
Wow. Okay. Isaac, great to have your perspective there. Isaac Poole, Global CIO and Portfolio Manager at Oreana Financial Services. Here's some other stories that we're tracking for you today. The Fed is said to have shown other U.S. regulators possible changes to its bank capital overhaul that would significantly lighten the load on Wall Street lenders. Bloomberg sources say the revisions could lead to a 5% increase in the capital cushion that large banks need to hold. That's down from about 16% in the original plan, which faced resistance from lenders and some Fed officials. UBS has agreed to sell the majority of its stake in Credit Suisse's China venture to a Beijing-backed fund. The sale values the brokerage at around $253 million. Beijing's state-owned assets management company takes an 85% stake, leaving UBS with a 15% one. Now, the deal is a blow to the ambitions of Ken Griffin's Citadel Securities that wanted and was looking to expand in China. Tencent's new blockbuster game, Dungeon & Fighter Mobile, has taken the top spot in China within a month of its launch. Industry tracker Sensor Tower says the game brought in $270 million on the iOS during the period, beating other titles in downloads and revenue. The Nexon-produced game is now widely seen as the best candidate to generate recurring revenue for Tencent. Tencent shares also now up some 1%, plenty more ahead. This is Bloomberg.
Right, so welcome back. You're watching the China Show. So veteran emerging markets investor Mark Mobius is gearing up for his new emerging opportunity fund. He discussed, of course, that traders need to certainly widen their scope as the world of opportunities continues to grow beyond the simply pure definition of EM. We spoke to Mobius for Bloomberg's latest Tiger Money podcast.
I think it doesn't make sense to just say, okay, I'm just going to go into India or go into China or go into emerging markets. You got to look global. And of course, yes, emerging countries are growing faster than the developed countries. No question about that. It's double the growth rate. So therefore, there's going to be more opportunities in the emerging countries, but there's so many companies listed in New York and London and other developed markets where the companies are actually emerging market companies because their earnings are from the emerging countries like India, China, Brazil, and other countries like that. So we've got to widen our scope if we want to be good investors.
So I'm wondering, what is the argument, or what's the best case you can make against U.S. exceptionalism? That there is a case to be made to be long EMs and simply not just leave your money and close your eyes and wait, say in an S&P 500 ETF, for example.
As I mentioned, the S&P 500 now contains so many companies that are benefiting from the growth in emerging countries. So you've got to be aware of the fact that when you buy Apple, you are buying not the U.S. market only, but you're buying China, India, et cetera, et cetera. So these countries are enabling the American companies, the multinational companies, to earn greater and greater profits. And therefore their stock reflects that.
So your Mobius Emerging Opportunities Fund that's about to come online, are you saying that, everything is fair game? So a company like Apple, which you correctly point out, you're effectively buying an EM stock if you think about it longer term, because increasingly their pie is China, India. Tesla is another one, for example. Would the S&P 500 companies, or would stocks in the U.S. be part of your eligible investment universe? Is what
yes, definitely. Yes, there's no question about that. And don't forget ADRs. Lots of ADRs are listed more and more. You're going to see emerging market companies listed in New York because of liquidity.
There you go, our conversation with Mark Mobius, co-founder at Mobius Capital Partners. And you can hear more of that conversation. If you wait till some point in the end, he has some food recommendations. So he now lives in Dubai, so he has specific recommendations there. He's in Singapore a lot, so he's also put forward some fare. And of course, here in Hong Kong, he also laid out, of course, some of his favorites.
What are they in Hong Kong? I'm curious.
If I say it now, maybe our listeners won't tune in.
Okay, fine.
Chinese food. Okay. There we go. That's as specific as I'll go. Tiger Money podcast, out every second Tuesday, including today. Previous episodes, of course, also available at those outlets on your screens.
All right, checking markets now. We're actually seeing equity markets doing quite well, and actually I think we're getting better around the region here as well, extending some of these gains here. We're focusing a little bit more on these power producers in Japan. So they're, according to local reports from the Nikkei, that they're going to let utilities recoup some of their unexpected nuclear costs. That's why you're seeing the likes of Tokyo Electric Power is up here today. Speaking of we're sticking into the industrial theme, I guess. We're watching all these machinery stocks in China also rising after we heard from President Xi Jinping urging scientists and researchers to enhance technological innovation with a greater sense of urgency. So more R&D in tech. So you're seeing some of these machinery stocks are surging here right now. We'll bring you to those. Well, GMM's looking like this here too. We are looking at equity gains. Dollar's also on the back foot here, so that certainly is helping as well. Bonds, to the most part, are slightly bid up here as well, so things are looking pretty good. We'll leave you with some live pictures at the World Economic Forum in Dalian. We're just minutes away from the Premier Li Qiang getting up on the stage there. Plenty more ahead. This is Bloomberg. You're looking at live pictures at the World Economic Forum in Dalian this morning here, where we're just, I believe, minutes away from the Chinese Premier Li Qiang, set to deliver his keynote address right now at the forum. Of course, this is the first in 5 years that we have had the World Economic Forum in China. So a lot has changed since then, everything from climate change, technological wars, even also geopolitical wars and the like here with Russia, with Gaza and the like. So certainly there's a lot on tap here, and it'd be interesting to see with the Premier how he's going to set the tone of this forum. Yeah, 1,500 participants, high-level leaders, business, government, what have you, press. Of course, in case you missed it, our man on the ground is Stephen Ingles there as well. It's the first time in 5 years, as Yvonne is pointing out, that it's been held because of the pandemic, and it's also the 15th iteration of this event. The first one is in 2007, amidst this meteoric rise in the Chinese economy and high growth. And at that point, the world embracing China's rise and how times have changed 15 years after. We're now here in a situation where the part of the world is pushing back against what China's actually become and afraid even further what China will eventually achieve. So we're now looking at, of course, I believe this is Klaus Schwab, of course, talking as we await, of course, the Chinese premier who is set to speak, and as Yvonne is pointing out, to what he says around the notion that China is certainly open for business, as China needs, of course, foreign domestic investment amidst, of course, the economics, the cyclical weakness that they're trying to push back against. Yeah, and the theme this year is the next frontiers for growth. So what are those growth drivers going to be, right? And you take a look at some of the topics. Obviously, they're going to talk about the global economy, China and the world, as you say, and how those dynamics have really changed in the relationship with China and the rest of the world. Entrepreneurship in the age of AI. So certainly that's one new topic that they haven't talked about in Dalian before, given all this kind of surge in investment and buzz really around this whole artificial intelligence story here, and the new frontiers for industries as well. That's certainly one of the key things that they're watching out for here today. Markets, though, looking pretty good, actually. If you take a look at how Asia Pacific is doing, stocks there are up about 0.8%. Futures are in the U.S. are pretty much flat here right now, but it's really kind of interesting how we're seeing this divergence from what we saw from the U.S. session. When we saw Nvidia down close to 7%, it's basically wiped out $400+ million in the past... Billion. Did I say billion? Yeah. Gosh. In the last 3 days alone. And you thought that was going to really kind of have a trickle effect here in this part of the world. But you got to wonder, is this sort of just this unwound of tech something that's just end of the quarter, end of the month rebalancing, or something more? Some of the big winners, right? So in our region, it's the likes of TSMC that's sort of ridden that AI wave, and we're also seeing some pressure coming through on that stock as well. And perhaps the reason, to Yvonne's point, the reason that we are seeing Asia Pacific 0.8 to 1% higher is you are getting some support coming out of the Chinese tech plays, which, by the way, we're not seeing. So when I talk about Chinese tech, it's the Tencent of the world, Alibaba's of the world, Meituan leading some of these gains, not seen in the same basket as this AI play. No. So when you are seeing sort of this pivot back to Chinese AI, for example, or Chinese tech, it is providing the sort of counter-cyclical current, if you will, to the broader tech weakness we've seen overnight, which is why HS Tech is up 0.8 to 1%. We're looking at that. But, the other side of the same story is, your Samsungs of the world. Disco was down substantially in Japan, down about 5% as we went into this lunch break. Yeah, that's why you're seeing that very left corner of that Asia dashboard, Infotech. That is where you are seeing the only sector that's in the red in the region here today. The rest is actually doing pretty well as well. And really, it's the fact that we saw, Treasury yields came down a little overnight. The dollar also softened a bit. That's really helping to support this sector. Right. And really, does this give you a chance, this unwound in tech, do you buy the dip or do you actually start rotating out, right? And maybe you start to see those rebalancing flows tilt more towards this part of the world, whether it's Japan, whether it's China as well, which we are certainly seeing here, a little bit of that here today.
Yeah, and certainly the commitment from Chinese authorities too, which is important, right? The timing going into the third plenum.
Yeah.
And, the market iteration of where the economy is this unrelenting rally in Chinese government bonds.
Yes.
So today what you're seeing is the long end leading those gains as well. So I think we're down 2.5 basis points in the 30-year yield. And, increasingly more that convergence between where you are on Japanese 30-year yields and Chinese 30-year yields. And you might expect some pushback from authorities against the notion that China is headed in that direction. Longer term, bonds are on the way down. Again, just in case you're joining us right now, we are live out of the World Economic Forum in Summer Davos over in Dalian. You are looking at Klaus Schwab, of course, who is introducing, of course, his next panel, who we believe, of course, we understand that the Chinese premier is set to speak in a couple of minutes. But against the backdrop of geopolitics.
Yeah, that's really going to be one key topic that's going to be happening at WEF here as well. Let's talk a little more about the latest there, with Beijing said to be floating benefits for Germans and the Germany's luxury car makers if Berlin convinces the EU to drop tariffs on Chinese EVs. Let's get to Min Lo, our China correspondent, joining us now with the details. So you mentioned there's been some carrots that have been dangled. What are they?
Yes, so China is now floating the idea of lifting the existing 15% tariffs on vehicles with large engines from Europe. So that will target companies like BMW, Volkswagen, Mercedes as well. And previously, Beijing had hinted that they would be unleashing 25% tariffs on these very same vehicles. So Beijing clearly dangling the carrots and the sticks here, trying to convince Germany to help it horse trade with the EU, because we know Germany has been one of the strongest critics of those EV tariffs. They say that it could spark a trade war, and Germany also has this massive auto industry that can really pressure the government to break ranks with the EC. But it remains to be seen, because we have that French counterweight, a big backer of the tariffs as well, whether these 11th hour talk will really bear any fruit for China.
Meanwhile, lots of moving parts, related parts to this is Canada, and they're coming out and they're beginning a process which could see them raise tariffs on Chinese EV imports.
That's right. They are starting this 30-day public consultation period, which will be the first phase before they can impose tariffs on Chinese EVs. And they're also looking into whether to increase restrictions on investments into EVs as well, and also whether to change the eligibility criteria for vehicles that qualify for this federal rebate program that now applies to electric vehicles from China as well.
All right, Min, thank you. Min Lo there, our China correspondent, with the latest on that. And there you go. You're seeing the man get up to the stage here right now, the premier himself, Li Qiang, set to make his keynote speech at the World Economic Forum in Davos. Let's listen in.
Distinguished guests, ladies and gentlemen, friends, good morning.
Targets for energy.
It is a great pleasure to join friends old and new here in the beautiful city of Dalian
given to us instead.
For the 15th annual meeting of the new champions.
We have made by ourselves.
Let me begin by extending on behalf of the Chinese government warm congratulations on the opening of the annual meeting and cordial welcome
over the years,
to all participants and journalists.
And turns and the changes in other countries' policies, like withdrawing or re-entry.
Like Professor Klaus Schwab mentioned, it has been 5 years since the Summer Davos was last held in the beautiful city of Dalian. In the past 5 years, global transformation not seen in a century unfolded at a faster pace, and world economic development reached a critical juncture. As many people wonder where the future of the world lies, this annual meeting, focusing on next frontiers for growth, is particularly relevant. I believe you all have your own thoughts and insights about the significance and value of exploring next frontiers for growth. Here, I would like to share with you 3 observations of my own. First, we need to confront the growth predicament of the world economy. We know the road to recovery has been treacherous since the onset of COVID-19. According to forecasts of the International Monetary Fund and other institutions, global growth may remain moderate or even slow in the coming years, and generally below the pre-pandemic level. Anemic global growth is not only caused by temporary factors such as impact of the pandemic, high inflation, and rising debt. It is also ascribed to some deep-seated problems and intrinsic issues. From a cyclical perspective, the three industrial revolutions since the 1760s, which were respectively marked by the utilization of steam engines, electricity, and information technologies, all transformed the way of production and life in human society. Each was followed by a surge in global growth. However, when the impetus unleashed by existing technological models diminished, global growth would slide into a period of stagnation. This is a pattern. The impact of such fundamental transformation is manifold. At the macro level, we would see a slowdown of economic growth and find it more difficult to make the pie of global economy bigger. At the meso level, we would see declining return on investment and diminishing returns to scale, with more business sectors turning from blue oceans to red oceans. At the micro level, we would see intensifying competition among market players and spiraling involution, a word created and popular in China. The neck-to-neck contest for available resources is to some extent triggering problems including backlash against globalization and escalation of geopolitical conflicts in some places in the world. Confronted with the growth predicament of the world economy, maximizing one's own benefits at the expense of others' interests, or even resorting to regressive actions of decoupling, disrupting supply chains, and building small yards with high fences, would only push up operational costs, sever the economic links between regions, and aggravate tensions and disputes. This would drag the world into a destructive spiral where the fierce competition for a larger slice ends up in a diminishing pie. This is something we do not want to see. As we Chinese often say, range far your eye over long vistas. In the current context, the right choice is to approach development issues with a longer view and broader mind, and join hands with others to make the pie bigger, while pursuing one's legitimate interests. This is how we could sustain the growth of the world economy and open new horizons for our own development. The second point I want to share with you is that we need to seize the new opportunities brought by the scientific and technological revolution and industrial transformation. This is very important. To overcome the growth predicament, we need to cultivate new engines for growth. We're delighted to see that as the new round of sci-tech revolution and industrial transformation deepens, global innovation activities in science and technology have become more intensive and dynamic than ever before, with the sparks ignited across domains. Next frontiers for growth are starting to take shape. From a technology perspective, this round of sci-tech revolution is mainly powered by progress in intelligent, green, and health technologies. The rapid advance of cutting-edge information, energy, and biological technologies has provided new pathways for tackling climate change, energy crisis, and other major challenges facing humanity. It has also notably enhanced the quality and efficiency of the supply system and catalyzed and generated massive new demand. From an industry perspective, breakthroughs and integration of frontier technologies have redefined traditional production function, triggered a quantum leap in productivity, and opened up new domains and avenues of business, including artificial intelligence, green energy, and biomedicine. I believe these sectors have the promise to evolve into multi-trillion-dollar pillar industries. And our business communities have high hopes for such sectors. From a business model perspective, as the sci-tech revolution progresses, the organization of economic activities and industries is undergoing rapid and salient transformation, which is characterized by the features of platform-based operation, networked structure, and ubiquitous presence. New forms and models of businesses are quickly emerging, especially in China. These include online services, C2M customization, and smart manufacturing, making our life smarter and more convenient, and giving everyone a fair and accessible chance to participate. In a word, a number of frontier technologies and industries with the potential of explosive growth are metamorphosing and ready to burst onto the stage. This brings light and hope for catapulting the world economy into a new upward cycle. We have confidence in that. To embrace the global trend of sci-tech advances and industrial development, all countries are making forward planning and deployment. China has also taken exploratory steps in this regard. In recent years, we have continued to promote high-quality development, accelerate the cultivation of new quality productive forces, and foster new drivers of growth. These efforts have provided strong dynamism for China's economic development and created greater cooperation space for companies around the world.
The rapid rise of China's new industries is in line with the global trend of sci-tech revolution and green development. Seizing the favorable opportunities from the sci-tech revolution and industrial transformation worldwide, China has been working hard to advance sci-tech innovation. We encourage companies to be first movers and make continuous investments in cutting-edge fields. Now, after years of cultivation, a number of enterprises and industries in China has gained an edge internationally. In particular, in recent years, China has been vigorously developing green industries, such as new energy, to address climate change with concrete actions and meet our twin goals of carbon peak and neutrality. And as a result, China's installed capacity of hydropower, wind power, solar power, and nuclear power under construction has all been topping the world for many years running, and the renewable energy now accounts for over 50% of China's total installed capacity. And the advanced electric vehicles, lithium batteries, and PV products made by Chinese companies have not only met domestic demand, but also enriched supply in the international market. It has also eased the pressure of inflation worldwide and made our active contribution to the global climate response. The rapid rise of China's new industries is rooted in our unique comparative advantages. As you know, China has a supersized market of more than 1.4 billion people. We have a complete industrial supporting system, abundant labor force and talent pool, and also, and more importantly, diverse scenarios for application. Plus, Chinese consumers are fairly receptive to new technologies. And all these make China a broad stage for enterprises to pursue innovation and upgrade their products. The economies of scale can effectively help to reduce innovation costs for enterprises and accommodate the growth of different technology roadmaps and business models in China. And that is how China's emerging industries get their competitiveness. The rapid rise of China's new industries is a testament to the principal role of enterprises in innovation. Enterprises stand at the forefront of the market, and they are most sensitive to the changes of demands, and they have the strongest desire for innovation. And from the Chinese government's perspective, we have been doing our best to foster a market-oriented, world-class business environment within a sound legal framework. And to that end, we've been abolishing regulations that limit market access and fair competition, facilitating the flow of factors of innovation to enterprises, and promoting fine entrepreneurial spirit so that enterprises can fully unleash the dynamism of innovation. I would also like to say that China's large market is open. Foreign companies, they compete, communicate, and cooperate with domestic ones on a level playing field, and they have become a major force enabling the birth and growth of emerging industries. The rapid growth of new industries and new drivers has buttressed the sound and sustained development of the Chinese economy. Since the start of this year, the Chinese economy has sustained the momentum of recovery. It got off to a good start in the first quarter of this year with a 5.3% year-on-year growth, and continued steady growth in the second quarter. We are confident and capable in achieving the growth target of around 5% for this year. And that concludes my second point. My third point is we need to open up a vast blue ocean for future economic development. Facing the major opportunities brought by the latest round of sci-tech revolution and industrial transformation, we will, as always, keep to the direction of building an open world economy, harness the momentum, make bold explorations, and work together to create new development space. And in this connection, I wish to propose the following. First, deepening sci-tech exchanges and cooperation. Science and technology are key variables in future development. And major sci-tech progress usually comes from unrelenting research, accumulation, and extensive cooperation. The exploration of new frontiers should not be seen as a zero-sum game. It is a process where all players compete for excellence and make progress together. A small yard, high fence approach cannot hold back the development of others. It only ends up constraining oneself. The wise thing to do is to create an open, fair, and non-discriminatory environment for sci-tech innovation on the basis of protecting intellectual property, so as to enable the free flow of ideas for innovation and creation. Second, enhancing the foundation for green development. There is only one Earth for humanity. Growth in the future has to be premised on harmony between man and nature. We need to stand by the goals and principles of the UN Framework Convention on Climate Change and its Paris Agreement, including follow the principle of common but differentiated responsibilities, and deliver on our respective emission reduction responsibilities. We cannot slow down our pace in green transition in exchange for short-term growth, nor practice protectionism in the name of green development or environmental protection. Green transition itself provides huge potential for development. We need to jointly advance the development of green and low-carbon industries and foster more growth drivers for the green economy. Third, safeguarding an open market environment. The history of global economic development shows that openness brings progress and isolation leaves one behind. Only through open interactions, exchanges, and mutual learning can we keep pushing the boundaries of development and discover and open up new frontiers. In many ways, the depth of international cooperation determines the height of human development. So it's essential that we embrace each other with open arms and work closely with each other. Reject bloc confrontation and decoupling, keep industrial and supply chains stable and smooth, and advance trade and investment liberalization and facilitation so as to promote the sound development of globalization and form a strong synergy for global economic growth. Fourth, promoting inclusive and mutually beneficial development. New technologies such as AI and big data, while contributing to economic growth, may also cause problems such as structural unemployment, economic inequality, and the technology and AI divide. It's important for us to coordinate the development and governance of new technologies and make timely improvements to laws and governance frameworks to address conflicting rules and social risks brought by frontier technologies and industrial development, and strive to achieve more inclusive development that benefits all. It's also important to provide education and training to vulnerable groups and upskill the workforce so that more countries and people can benefit from innovation. Ladies and gentlemen, friends, development has no limits. Exploration knows no boundary. China stands ready to join hands with all countries to sail the giant ship of the world economy into a vast blue ocean and create an even brighter future for humanity. I wish the annual meeting a full success. Thank you.
And that was, of course, the Chinese Premier Li Qiang there, just wrapping up his speech that lasted just about 10 minutes or so. Really the keynote address for the World Economic Forum in Dalian. As we mentioned, it's the first time in 5 years that they've had it in China. And certainly he addressed a little bit of some of the tensions that the world is facing with, whether it's the slowing of the global economy, in which he did talk about we must confront the growth predicament of global economy. The world needs new engines for growth, and disrupting supply chain drags the world into a destructive spiral. And that's really where I saw he really started to build the case around China being still open for business. Yeah. We have to avoid, or at least try not to sever this whole globalization theme as well. And that really, he said he wants to embrace, have the two worlds of the U.S. and maybe China and the West in general, really embracing each other with open arms. So there was this kind of message of openness, I felt, coming through the premier. And pushing back against, trade protectionism, I think, is one. Yes. One of the first points, in fact, he made. And, what was really a shorter than expected speech was one of the points that he underscored was, this scramble for the limited resources we have is triggering global problems, right? Which is, I think, what we have bottom of your screens for our viewers, right? So he reiterated that the Chinese market is open, it's large, they're welcome for business, they're exploring new frontiers,
that we should not be looking at sort of the rise of China as a zero-sum game. It's game on for everyone, and of course it's a welcome conversation to have. He also talked about needing these new frontiers of growth. Like in one is new productive forces, I think might be a similar concept of an overlay there.
Yeah, that's when he talked about when it comes to electric vehicles, other products. Green tech, the like here, that enriches the supply in the international market. So really kind of pushing back on what we've been hearing of obviously with EU proposing these tariffs on Chinese EVs. And really talking about the domestic economy as well, and really saying that the economy sustained momentum of recovery. So still kind of highlighting a pretty positive note on the Chinese economy right now. And in fact, he seems like he's confident, according to the Premier, in achieving that 5% growth target this year. So certainly some optimism there from the Premier, but really still talking about deepening this cooperation, whether it's with tech exchanges, whether it's creating this fair, non-discriminatory tech environment as well. So really trying to play a more, I guess, how do you say it? I mean, a more open, more
diplomatic
conciliatory sort of message to the world.
We'll leave you with these live pictures, and just in case you're just joining us right now, we're live at the World Economic Forum in Dalian, where the Chinese Premier just wrapped up his speech. Also on stage, in case you're wondering, of course, is Klaus Schwab. You have the Polish president, and you also have the Vietnamese prime minister in the opening plenary here at the World Economic Forum taking place in Dalian. At this point in time, let's toss it back, and we'll now pass the baton to our colleague and our co-anchor in Singapore, Haslinda Amin, of course. That's it from us here on The China Show. All yours. Take it away.